In November, OpenAI introduced ChatGPT, a language-generating model that could provide surprisingly comprehensive and coherent responses to most topics. ChatGPT is a tremendous asset and instrument if you know what questions to ask it. The app quickly gained popularity, reaching 1 million users in just 5 days, prompting Microsoft to discuss a $10 billion investment. When asked to compose a stock market story on trading movements in 2020, it produced a 400-word piece that laid out S&P 500 moves, meme stocks, and shares that soared in the early days of the pandemic in less than 1 minute. In 2020, the stock market experienced a roller coaster of ups and downs as a result of the ongoing COVID-19 pandemic. As more people moved their lives online for work and play, the bot said, there was a major shift in the market toward technology equities. According to ChatGPT, stay-at-home stocks grew as people stayed indoors during lockdowns and avoided social interaction. The year 2020 also marked the entry of individual retail investors in stock markets through trading apps. These apps allowed retail investors to invest in stocks at lower amounts and even use leverage to trade. This made a huge impact on the market as the number of individual investors increased, leading to increased volatility in some stocks, specifically the so-called meme stocks, that went viral on social media platforms and were heavily bought by retail investors. When ChatGPT was questioned about its market perspective, it replied it couldn't make a prediction, because its knowledge cutoff date is 2021 and it doesn't have access to real-time data. But that didn't stop it from offering a fair analysis. In the short term, the market can be affected by many unpredictable events such as natural disasters, geopolitical tensions, and so on. But in the long term, it tends to be driven by the underlying health of the economy. One of the key factors that will likely affect the stock market in 2023 is the pace of economic recovery from the COVID-19 pandemic. As the world continues to grapple with the pandemic, economic growth may be slower than usual, and this could have a negative impact on the market. On the other hand, if the world economy continue on the path of recovery, it could boost the market. Additionally, policy changes from governments and central banks, such as interest rate decisions, could also affect the market. It's worth to mention that the world is moving towards digital and sustainable technology, so the stocks related to this sectors could do well. In conclusion, predicting the stock market is difficult and there are many factors that can affect its performance. While there is always uncertainty, the key factors to watch in 2023 include the pace of economic recovery from the pandemic, changes in government policies, and global events. Keep in mind that this is not a financial advice. You should always do your own research and consult with a financial advisor.